Welcome to the deep dive. Ever wonder what happens behind the curtain when a bank winds up owning a property they never really planned on having? Well, today, that's exactly what we're tackling. We're diving deep into, the complex, sometimes tricky, but actually pretty opportunity-rich world of bank real estate owned or REO disposition. And we've got a fantastic source guiding us, a really comprehensive guide by Michael Linton. He's the founder of the Chicago Deal Flow team, a major player in Chicago's commercial real estate world.
That's right. Our main source is Michael Linton's work. You can check it out at chicagodealflow.com. He's literally written the guide on mastering the $200 billion REO market.
Mm.
And when you hear a number like $200 billion, you realize pretty fast this isn't some, tiny niche. It's huge and complex. It needs smart strategies.
With $200 billion. Yeah, that certainly puts it in perspective, doesn't it? So for you listening, the big question we're exploring today is how do banks actually navigate this? How do they turn these potential big liabilities into, well, profitable outcomes? It's not just about identifying the problems, but figuring out the solutions.
And what Michael Linton's guide really emphasizes is that this market needs more than just like basic property management. It's a strategic imperative for these institutions. He really sets the stage that this deep dive will give you actionable solutions, things banking pros and, anyone curious, like you can really understand, maybe even use right away. I mean, in 38 years of experience, that tells you something. He knows the history, but also looks ahead with really practical strategies.
Absolutely. That mix of, deep regulatory knowledge and real-world boots-on-the-ground experience, that's what makes his guide so valuable for bankers, asset managers, anyone involved in REO. Okay, so let's unpack this a bit more. What is REO exactly? We hear the term, but what does it mean in the bank's world?
Right. So at its core, REO, or sometimes you'll hear OREO, owned real estate, it's just property that a financial institution like a bank takes ownership of. Usually it's through foreclosure. But it's not just foreclosure. It could be a deed in lieu where the owner kind of hands back the keys voluntarily to avoid the whole foreclosure mess, or even through a bankruptcy. And the variety is pretty amazing, actually. It could be anything from a single house, 1 to 4 units, up to big apartment buildings, commercial properties, farms, even half-finished construction sites.
Okay, so how does a property make that jump from being, a loan someone's paying on to suddenly being owned by the bank? What's that path look like?
Well, it's definitely a process. It often starts way before the actual foreclosure, in pre-foreclosure. If the loan defaults, the bank starts the foreclosure process. Then comes the auction. The bank usually puts in what's called a credit bid, basically bidding the amount they're still owed. If nobody outbids them, well, the bank takes title. And that's where all the rules and regulations really kick in hard. What Michael Linton really highlights here is the federal oversight. The OCC, the Fed, the FDIC, they have strict rules. And a really critical one is 12 CFR Section 34.82, the holding period.
Yes, the 5-year clock. That's a massive deal in this space, isn't it?
It's absolutely central. Yeah, banks generally can't just sit on these REO properties forever. They have a maximum of 5 years to sell them. And that's not a suggestion, it's a regulation. So it puts huge pressure on them to move these assets. Plus, you've got state rules, like redemption periods where the old owner might get a chance to buy it back. And then the really big one, environmental compliance. You've got laws like CERCLA, the Superfund Act, RCRA, the Clean Water Act. Banks have to be super careful about hazardous materials on the site, even if they didn't cause the contamination.
Wow, yeah.
Which is why that initial homework phase, environmental checks, careful title searches, checking for lints, it's all absolutely crucial right at the start.
Okay, so hurdle 1 is just getting the property and knowing the basics. But hurdle 2, which Michael Linton really emphasizes, sounds even trickier.
Yeah.
Navigating this maze of compliance and risk. What are the biggest regulatory headaches, and how does his guide suggest banks deal with them?
Well, arguably the biggest headache is that constant tick-tock of the 5-year clock, combined with just the sheer volume of compliance tasks. The OCC, for example, doesn't just set the time limit. They demand detailed records of everything the bank does to try and sell the property. Another really big one, sometimes overlooked, is AFFH, Affirmative Furthering Fair Housing. Banks have to market and maintain these properties equally across all communities. They need to think about geographic distribution, avoid any appearance of discrimination. Getting that wrong means big legal trouble and serious reputation damage.
And the environmental stuff like CERCLA. That sounds like it could be a bottomless pit financially.
It really can be. CERCLA can make the bank liable for cleanup costs just because they've now owned the property, although there are some protections for secured creditors. But still, you absolutely have to do your due diligence for things like asbestos, lead paint, you name it. Disclosure is key. And all this ties into the bank's overall risk management, right? Market swings affect the property values. These bad assets hit the banks all their allowance for loan and lease losses.
They're cushioned for bad loans.
Exactly. So Linton's guide stresses having solid plans for keeping the property secure, maintained, insured. It's all about managing that ongoing risk proactively.
Right. So the bank owns the property. They're navigating the rules. How do they figure out what it's actually worth and then, get rid of it? What are the main ways they value these distressed properties?
Valuation is absolutely critical, and any formal appraisal has to follow USPAP standards. That's the professional code for appraisers. It ensures consistency and ethics. Linton's guide clarifies the differences, between a quick BPO broker price opinion versus a full detail appraisal, or maybe using an AVM, an automated valuation model. They all have their place. But for distressed properties, you can't just use standard methods like sales comparison or cost approach without adjustments. You have to factor in all the deferred maintenance, the repairs needed right now.
So it's not just market value. It's market value minus all the problems.
Yeah.
How does that translate into a sales plan?
Precisely. So developing the disposition strategy means digging into the local market, what's selling for how much. You look at comps, obviously. You also have to think about timing. Selling a beach house in winter might not be ideal. Economic cycles matter too. Then the bank faces a key choice. Sell it as is right now, probably for less, but faster. Or do they hold and stabilize, fix it up, maybe rent it out to get a better price later? But remember that 5-year clock.
Always ticking.
Always ticking. Market timing is huge. Then for the actual selling, they use all the tools. MLS listings, maybe direct outreach to known investors. Auction sites are increasingly popular too. Linton also covers more complex stuff like selling a whole bunch of properties together in a bulk sale, or maybe converting them into rentals through specific programs. And importantly, how to handle situations with existing tenants, navigating their rights, eviction processes, sometimes using cash for keys to encourage occupants to leave smoothly.
Okay, so connecting all these dots, what's the impact on the bank's actual finances? How do they measure if they're doing a good job managing these REO assets? Because ultimately, it's about the bottom line.
Yeah, the financial impact piece is crucial. The biggest hit is usually on the bank's ALL, that loss allowance we mentioned. Every REO property represents a loan that went south, and the bank has to set aside capital to cover that expected loss. Michael Linton's guide gets into the weeds on how they calculate this using things like probability of default, PDAY, loss given default, LGD, exposure at default, EAD. There are specific accounting standards like ASC 310 versus ASC 450. But the key takeaway for you is that these calculations directly affect how much capital the bank has tied up, which impacts their overall financial strength and ability to lend.
Got it. So doing REO well frees up capital. What metrics are they watching closely to track their performance?
Exactly. And besides the provisioning, they do a lot of stress testing, like what happens to our REO portfolio if the market tanks? How does it affect our capital? But for measuring success day to day, they track things like the average number of days it takes to sell an REO property days to disposition. Also, the recovery rate, how much of the original loan amount did they actually get back after all expenses? And the cost to dispose ratio is key too. Are they spending too much on maintenance, legal fees, sales commissions compared to the sale price? Tracking these KPIs, these metrics, is vital for them to optimize how they handle REO and, keep improving.
Right. This sounds like a massive undertaking. And Linton's guide points out it's not something banks do alone. Partnerships are key. Who are the essential partners in this REO world?
Oh, absolutely. It's a whole ecosystem. Banks really need to cultivate good relationships with other banks, maybe for portfolio sales or sharing best practices. They need strong networks of qualified investors, people or funds ready and able to buy these often distressed properties. And then there's the whole team of service providers, specialized lawyers who know REO law inside out, environmental consultants, property preservation companies who board up windows and cut the grass.
Appraisers too, right?
Appraisers, definitely. Title companies, real estate brokers specializing in REO. Managing this network effectively is critical because, like you said, banks can't be experts in everything.
Makes total sense. Looking ahead then, what kind of future trends does Michael Linton see impacting this REO space? What should banks be watching?
He's definitely got an eye on the future. The guide consistently links REO strategies to the bigger picture. Overall foreclosure trends, which can vary a lot by region, obviously interest rate movements, general economic health, and a big theme is the rise of PropTech property technology. We're talking about using better AVMs for faster valuations, more sophisticated digital marketing, using virtual tours, and leveraging data analytics, even predictive modeling, to make smarter decisions about maybe when to sell or which repairers offer the best ROI. Linton also emphasizes just staying vigilant, always preparing for new regulations, new guidance from the OCC or FDIC, and having solid plans in place for crises, like a sudden market downturn. It's about being ready.
Wow. Okay, what a comprehensive journey we've taken from just defining REO all the way through the regulatory tangles, the strategies for valuation and selling, the financial impacts, and now future tech. It really feels like we've done a deep dive into bank REO disposition, thanks to Michael Linton's guide. His, almost 4 decades of experience really shines through, making complex stuff feel, well, understandable.
It really does. And I think that's the crucial point for you listening in. In today's, fast-moving financial world with this huge $200 billion market in distressed assets, understanding REO isn't just academic. It's not just about banks ticking compliance boxes or even just maximizing profit on a single property. It's actually about something bigger. Turning potential liabilities, properties that could drag down a neighborhood, into actual community assets. It contributes to economic stability.
It's a really powerful way to frame it. So the question for you to think about is, how might understanding these specific practical strategies, the valuation nuances, the compliance hurdles, the partnership models, how might that help you spot opportunities or maybe manage risks, whether it's in your job or even just understanding your local market?
It's definitely food for thought.
Yeah.
And again, a huge thank you to Michael Linton for providing such incredibly detailed and insightful material for this discussion. It truly is a masterclass. We hope this deep dive has sparked your interest to keep exploring these important areas.